$44.3 billion. That is how much the federal government is projected to send directly to American farmers in 2026, and that single number accounts for nearly 30% of every dollar the entire farming sector earns. Strip that check away, and the majority of row crop operations in the country immediately operate at a loss. What was built as a safety net has quietly become the only thing preventing the floor from collapsing. And in 2026, that floor started to crack from three directions at once. $153.4 billion. That is the forecast for total net farm income in 2026, a number that sounds stable until you pull it apart. Adjusted for inflation, it marks a 2.6% contraction from the prior year and sits roughly $48 billion, or 24%, below the peaks recorded in 2022. Expectations of a healthy rebound in 2025 never materialized. Net farm income settled at an estimated $154.6 billion, which landed $25 billion below where analysts originally expected it. Net cash farm income followed the same trajectory, revised downward to $153.9 billion, nearly $27 billion short of the initial outlook. Buried inside those headline numbers are cost structures that refuse to budge. Production expenses across the sector remain lodged at $477.7 billion, creeping up another 1% from the prior year. Feed spending did drop $4.8 billion, a 6.8% decline, but livestock and poultry purchase costs swallowed that savings and then some, climbing $5.9 billion at a 9.7% rate. Cash labor alone eats $53.9 billion. And here is where the dependency becomes undeniable. The $44.3 billion in projected government payments represents a $13.8 billion jump, 45.2%, from revised 2025 levels. Title I commodity programs are now triggering enormous payouts because market prices have fallen below the elevated statutory reference prices that Congress locked into law. For agricultural lenders, one metric matters above everything else: the debt service coverage ratio. When that number drops below 1.0, the operation can no longer organically service its debt. Selling assets, burning through savings, or refinancing short-term operating lines against long-term real estate all become the only options, and none of them are sustainable. Across 2025 and 2026, the projected DSCR for the average corn operation sits at 1.04, barely clearing the threshold. Soybeans come in at 1.07. Wheat collapses to 0.80, well below the line. Every one of those numbers assumes that every dollar of the $44.3 billion in projected payments arrives on time and in full. Because government payments carry virtually no marginal cost of production, any reduction in that revenue flows straight out of the farm's capacity to cover its debts. Remove just one layer of that support, and the math falls apart entirely. If discretionary ad hoc payments stall because of partisan gridlock or budget sequestration, the DSCR for the average corn and soybean operation drops below 1.0 immediately. A secondary measure called the replacement margin coverage ratio, which accounts for the capital needed to replace aging machinery, is even more exposed. Simulate a 10% drop in gross farm revenues while holding sticky costs constant, and that ratio crashes from 2.11 down to 0.63 for the most leveraged operations. At that level, the farm cannot fix a broken combine or make a scheduled payment on existing debt. It is technically insolvent. None of this is hypothetical anymore. Purdue University's Ag Economy Barometer tracks the share of producers who need larger operating loans specifically because they are carrying unpaid debt from the prior year. That number climbed from 5% in 2023 to 17% in 2024, hit 23% in 2025, and reached 31% by early 2026. Working capital reserves that producers stockpiled during the 2021 through 2022 commodity boom have been completely burned through, with aggregate working capital forecast to shrink another 9.2%. Chapter 12, Farm Bankruptcies, surged 46% in 2025, reaching 315 cases, concentrated heavily in the Midwest and Southeast. Arkansas more than doubled its filings from the prior year. Total farm sector debt is on track to increase by $30.8 billion, or 5.2%, hitting a record $624.7 billion. Debt-to-asset ratios sit at 13.75%, which looks manageable, until you realize the liquidity crisis is eroding far faster than the balance sheet. And this is where it gets worse, because the banking system amplifies the damage instead of absorbing it. The Federal Reserve's prolonged fight against sticky 3% headline inflation produced gradual easing of short-term policy rates toward roughly 3% by year's end. But long-term Treasury yields refused to follow. Markets embedded higher inflation expectations and demanded larger term premiums to absorb the $1.8 trillion federal deficit, which generated extreme distortions in agricultural lending. Under normal conditions, operating loan rates hover about 27 basis points below intermediate machinery loans and roughly 45 basis points above long-term real estate rates. That relationship has now inverted. Short-term operating loan spreads spiked to plus 87 basis points above real estate rates, the widest gap in more than 3 decades. USDA Farm Service Agency locked direct operating loan rates at 4.625% and direct ownership loans at 5.625%, but commercial operating notes averaged near 8 to 8.5%. For a producer carrying $500,000 in operating debt, a repricing from a historical 5% to 8.5% strips out an additional $17,500 in annual interest expense. Capital ripped directly from an already negative margin. Lenders have responded with enhanced collateralization requirements, geospatial intelligence systems that map climate and yield risks at the parcel level, and automated sweep accounts that rebalance operating positions nightly to minimize interest charges. But when federal payments lag, the options narrow to restructuring debt against farmland, offloading risk through FSA loan guarantees, or initiating foreclosure. What makes this trap inescapable is the way subsidies leak into real estate. AR, C, and PLC payments are tied to historical base acres, not to current production. Econometric research demonstrates that for every marginal dollar of subsidy per acre, cash rental rates climb approximately 12 cents in the short run, and between 37 and 43 cents over the long run. 94% of landlords do not actively operate a farm, which means up to 40% of taxpayer funds earmarked for working producers ends up transferred directly to non-farming landowners in the form of inflated rents. Between 2014 and 2023, 9 major field crops accumulated $32 billion in cumulative private market net losses, while simultaneously collecting $120 billion in safety net payments. That massive subsidy injection drove cropland prices up 52% and pushed cash rents 21% higher. If the $44.3 billion falls short or arrives late, tenant farmers remain contractually locked into those hyperinflated rents, which were negotiated under the assumption that maximum federal support would continue indefinitely. Cash rents take years to adjust downward after land prices drop. The farmer absorbs every dollar of the margin compression, while the landlord's returns stay temporarily shielded. Financial stress at the farm level transmits vertically through every link in the supply chain. Upstream, capital spending collapsed. The Farm Capital Investment Index dropped to its lowest reading since October 2024, with a mere 4% of producers planning to increase machinery purchases. Deere posted first quarter 2026 net income of $656 million, down from $869 million in the same quarter the year before, and management guided for a 15 to 20% decline in large agriculture equipment sales across the U.S. and Canada, revising full-year net income expectations to a range of $4.5 to $5 billion. CNH Industrial pulled back tractor and combine production lines to prevent dealer lots from swelling with unsold inventory. Fertilizer prices remain structurally sticky from global supply chain constraints and geopolitical export restrictions. But weakening farmer affordability has pushed buying patterns toward delayed, just-in-time procurement and lower analysis nitrogen products. Downstream, Grain elevators face their own squeeze. Carrying costs run 10 cents per bushel per month for corn and 14 cents for soybeans, driven overwhelmingly by the interest burden on capital tied up in physical grain at 8%. As producers hold on to inventory in hopes of future price recovery or the arrival of delayed government checks, elevators struggle to secure the bushels needed to fill forward contracts. That changed when politics entered the picture. On July 4, 2025, the One Big Beautiful Bill Act cleared Congress via partisan reconciliation. Statutory reference prices jumped 10 to 21% across major commodities. Soybeans went from $8.40 to $10 per bushel. Medium grain rice climbed from $14 to $16.90 per hundredweight. Peanuts rose from $535 to $630 per ton. Other oilseeds increased from $20.15 to $23.75. A reference price escalator kicks in starting 2031, allowing prices to compound at 0.5% per year, up to 115% of their original value. Full bonus depreciation returned through 2029. Section 179 small business expensing limits jumped to $2.5 million, with a $4 million phase-out threshold, and estate tax lifetime exclusions reached $15 million per individual, $30 million for married couples. Paying for all of it required deep cuts in a single place. $186 billion was stripped from the Supplemental Nutrition Assistance Program over a decade through tightened work requirements and recalculated utility allowances. Another $1.8 billion in Inflation Reduction Act clean energy and conservation funds was rescinded. $14 billion in unspent IRA conservation funding migrated into the Farm Bill conservation title, converting what had been a one-time cash injection into a permanent spending baseline. And this is where the political architecture fractured. Since the 1970s, farm bills sailed through Congress with bipartisan supermajorities because urban Democrats secured SNAP funding while rural Republicans locked in commodity subsidies. A durable coalition built on mutual self-interest. The OBBBA used partisan reconciliation to sever that bargain entirely. Row crop subsidies now stand exposed, without a vested urban constituency defending the broader agricultural omnibus. Bridging the gap between the old Farm Bill's expiration and the OBBBA's new reference prices required emergency action. On December 8, 2025, the USDA launched the Farmer Bridge Assistance Program, a $12 billion cash infusion. $11 billion went to row crops and $1 billion to specialty crops. Per-acre rates heavily favored capital-intensive staple production, rice at $132.89, cotton at $117.35, oats at $81.75, peanuts at $55.65, sorghum at $48.11, corn at $44.36, wheat at $39.35, and soybeans at just $30.88. An average 1,500-acre grain operation in soybeans would collect over $56,000. Payments capped at $155,000 per producer, with entities reporting adjusted gross income above $900,000 excluded entirely. Specialty crop producers, who generate over $75 billion annually in cash receipts, continue to operate without statutory reference prices or comparable insurance coverage. Losses in 2025 alone reached $3.6 billion for almonds, $1.4 billion for apples, and $763 million for lettuce. At the same time, federal funding for public agricultural research and development, adjusted for inflation, has collapsed by roughly one-third since its peak in 2002, allowing China to overtake the United States in total research volume. What makes all of this harder to manage is the gutting of the agency responsible for delivering these programs. Between September 2024 and December 2025, the USDA shed 27% of its total workforce. The Forest Service lost 32% of its staff. The Agricultural Research Service lost 30%, and the Animal and Plant Health Inspection Service lost 23%. At the Farm Service Agency, the frontline point of contact for farmers applying for safety net programs, more than 1,200 employees departed. carrying an average of 18.6 years of institutional knowledge with them. On February 28, 2026, the fiscal equation got blown wide open. The United States and Israel launched Operation Epic Fury, a coordinated military campaign targeting Iranian nuclear and military infrastructure. Iran retaliated by closing the Strait of Hormuz, choking off 20% of globally traded oil and disrupting a corridor responsible for massive volumes of liquefied natural gas and fertilizer exports. Brent crude surged from roughly $70 per barrel past $110. Ammonia prices spiked 20% within weeks, and urea climbed 50% because natural gas serves as the primary feedstock for both. Gulf states that account for 30% of global seaborne urea fertilizer exports were severely disrupted. The White House responded with an emergency 60-day Jones Act waiver to allow foreign-flagged vessels to move energy and agricultural inputs between domestic ports. $11.3 billion in 6 days. That is what the opening phase of the operation consumed. By day 12, cumulative costs reached $16.5 billion, with a sustained burn rate of $500 million per day. Munitions expenditure alone hit $5.6 billion, including Tomahawk cruise missiles at $3.5 million per unit. The Department of Defense prepared a $200 billion emergency supplemental budget request, and farm organizations petitioned the White House to integrate agricultural relief funding directly into that defense spending package, arguing that if producers were absorbing the macroeconomic blowback of war, relief should not be confined to defense contractors. The fiscal collision that defines 2026 sits on top of a structural deficit of $1.9 trillion, 5.8% of GDP. Debt held by the public stands at 101% of GDP. Net interest outlays already exceed $1 trillion annually. CBO projections indicate the average nominal interest rate on federal debt will surpass the nominal growth rate of the economy by fiscal year 2031, creating a debt spiral where existing obligations compound faster than the tax base can grow. Each 1 percentage point increase in the debt-to-GDP ratio pushes the 10-year Treasury yield up by approximately 2 basis points. And for every dollar increase in the federal deficit, private investment contracts by 33 cents, directly shrinking the pool of capital available to agricultural lenders. 3 distinct crowding out mechanisms now threaten the farm safety net. Under mandatory sequestration, non-exempt agricultural programs already face a 5.7% baseline cut. A 10% sequester applied to the OBBBA enhanced ARC and PLC baseline would strip over $1.1 billion annually from producers. Crop insurance premium subsidies present the second target. The government currently covers an average of 60% of a producer's premiums, and a reduction to 50% would shift billions in risk management costs back onto operations already running negative margins. The third mechanism hits hardest. Ad hoc disaster assistance simply disappears. Between 2018 and 2025, nearly $40 billion in supplemental disaster packages flowed to farmers as emergency spending that required no budget offsets. Under any war spending scenario with binding fiscal constraints, that era ends. Those elevated OBBBA reference prices doubled the projected 10-year cost for ARC and PLC, from $48.7 billion to $113.2 billion. PLC alone jumped threefold to $94.7 billion. The legislation authorized the addition of approximately 33.1 million new commodity base acres, the first update to the base system since 2014. ARC guarantee levels climbed from 86% to 90% of benchmark revenue. Payment rates per base acre now range from $279.99 for peanut base, all the way down to $19.08 for soybeans. Every American conflict replicates this pattern. During World War II, more than 1/3 of GDP fed the military machine. Conservation programming was shelved for maximum output, and the early federal crop insurance experiment halted in 1943 after accumulating $11 million in underwriting losses. Korea drove defense spending from a post-war low of $13.5 billion up to $50 billion, which Truman partially offset by raising the top marginal income tax rate to 92%. Vietnam produced the most destructive delayed effect. President Johnson refused to raise taxes until 1968, while pursuing military escalation simultaneously, igniting an inflationary spiral that combined with reckless farm borrowing throughout the 70s to trigger the devastating rural credit crisis of the 1980s, when farmland values collapsed 20% between 81 and 85, and the debt-to-asset ratio peaked at an unsustainable 22%. After September 11th, the ghost budget emerged, a term for the continuous stream of emergency supplemental appropriations that financed the wars in Iraq and Afghanistan entirely through debt, providing $612 billion in new budget authority between fiscal year 1997 and 2006, with the Department of Defense absorbing nearly 60%, while conservation programs with large, unobligated balances became prime targets for rescissions. What looks like stability in 2026 farm income is a statistical illusion, propped up by over $44 billion in federal payments and cyclical strength in the beef cattle market. For row crop operations, genuine economic margins sit deep in negative territory, and any reduction or delay in policy support detonates an immediate liquidity crisis. Subsidies have been systematically capitalized into land values and baked into multi-year rental agreements, trapping tenant farmers inside a rigid cost structure built on the assumption of permanent government support. If that revenue stream breaks, operators must borrow at 8% at the exact moment lenders are raising collateral requirements and tightening credit standards. Compounding interest eats into the debt service coverage ratio month by month, transforming what begins as a temporary cash flow disruption into permanent insolvency. Farmland valuations remain resilient enough to prevent a systemic collateral collapse like the 80s, but the trajectory mirrors the grinding working capital erosion of 2014 through 2016, only now at 8% interest rates instead of near zero. No buffer remains. The timely execution of the federal safety net is the only mechanism standing between regional stability and a cascade of agricultural defaults, and that mechanism depends entirely on the political will of a deeply fractured Congress, operating under wartime spending pressure, record national debt, and midterm elections 6 months away.